Hi, I'm Bill Baruch, president of Blue Line Capital. I'm here with our analyst, Jannis Meindl, and it's the Triple Play podcast. Thanks again for joining us. We're excited to have you, excited to watch this. We start off some macro. We move into three stocks that we're covering here this week. Let's get to it. Jannis, start us off with the macro.
Thanks, Bill. So, as always, we'll kick it off with some data. I'll skip credit spreads, but I think one of the more important dynamics, and Bill, you'll cover some housing data that came out this week, as well as inflation data that we just got this week. But I'll just talk about housing here real briefly. So housing has been one of the sectors that the Fed has turned to, and they want to see a rollover there and sort of continuing to support the disinflationary story. But one of the key themes in housing is that really post the great financial crisis, this country has underbuilt housing. And we can see that prices are not too far off the highs. And despite buyer sentiment in the housing area being quite suppressed, there was a Fannie Mae survey that came out that illustrated that only 17% of collective home buyers say that it's a good time to buy a home. But regardless, prices are not really coming off. You have a lot of demographic tailwinds supporting this market. And you just have this underbuilding story, and that's clearly illustrated by the fact that vacancy rates, so how many homes or apartments are vacant, and those are pretty much at all-time lows. So in Moody's data set actually indicated that current vacancy rates translate into 1.5 years of housing undersupply. So you can expect that there will continue to be a housing shortage in this market. And I think one of the predominant dynamics that we're watching as well as that economic data in general, and you'll be talking about this more with retail sales, but economic data in general has kept up pretty much. And is that going to translate into more hawkish rhetoric from the Fed or not? I'll leave it to that, Bill. Why don't you take over on the macro side?
It's been an interesting week of data so far. We've gotten a lot, really the first big number, CPI, and the year-over-year numbers came in more than expected. Headline 6.4, they're looking for 6.2. And the core number came in a tenth above expectations. I mean, these are still very elevated levels. They shifted the calculation a little bit to lean more on shelter and less on energy. See how that works going forward. I mean, here's the theme really is inflation isn't backing down. It's really remaining pretty steady. And the month-over-month read of a 0.5% increase headline is the biggest increase in 7 months. So, a lot of Powell's disinflation also was sort of batted down today with PPI. PPI was a hot number, hotter than expected. We saw 0.7 increase month over month. We also saw some of the disinflation from December revised out of that. And remember, producer prices are a leading indicator for consumer prices, and you also get added tailwinds in consumer prices. I've been writing about it in the Morning Express, both the last 2 days. So check it out. But really talking about how we've had a narrative here that we expected the consumer to be strong and really not only bounce back, but really be steadily strong in January. That's what we saw in retail sales data that came out yesterday. There's a 3% increase month over month, much more than the 1.8%. It was the largest month over month increase going back to last January. And again, these are bounce backs from December, but I think the narrative is sort of a social evolution rather than giving the Fed credit for the slowdown in Q4. I mean, and I've talked about it here in this podcast where you get, people that really sort of between Thanksgiving and New Year's hunker down. They're actually not spending money now. They're waiting for deals in January. They're spending time with their family. So this ever-connected world, it's sort of almost like a checkout. And now when January comes around, you're getting a lot more activity. And a lot of the activity, I think it was a 17% increase in department stores. People are out. Eating and drinking was a 7% increase month over month. We've heard from Airbnb. We've heard from Marriott this week. We've heard from travel companies this week, which were upbeat on consumer travel. When people are out, whether they're shopping or traveling, they're spending more money. This is an indicator of inflation. It's a leading indicator of more inflation to come. The other thing is the job market. We all know, and we talked about it last week, was the non-farm payroll, 517,000 jobs. For January, we've seen wages kind of remain steady. Even though they've come down, they're still at elevated levels. So the purchasing power is there. I know you noted some delinquencies. It's sort of similar way I look at these delinquencies is they're getting back to more normal levels. So people talk about a rise in delinquencies, but it's really not, it's something that's an outrageous number. I think overall, you look at it as consumer savings where people have drawn down their excess savings from the pandemic. So this is extra savings since the pandemic by 35%. And then by the end of the year, Goldman Sachs is what noted this is expects them to be drawn down by 65%. So they're really just drawing down the excess savings. The high end consumer is still very strong. So I think it really tells us inflation is going to be here. And the early numbers for Cleveland Fed are looking for 57 basis points increase month over month headline inflation. So we'll see. Let's move on for the macro and jump in. And we're going to start here. Our first stock today, AbbVie. This is a name that we've owned for, since we started the investment advisor a few years back. And we've throttled it to be a larger portion or a smaller portion at times. And really, I'll get to the chart at the end, and there's been a really terrific trend line. But it's been a really great number, a really great company to own. And right now, we've actually increased our ownership. It's a top 5 position of ours in most of our portfolios. Here's the thing: the earnings were lukewarm, but the stock really responded very well in the 2 days after, in the aftermath of reporting. There was obviously some worries that the patent falling off for Humira, the arthritis drug, where they have $20 billion of revenue, is going to continue to weigh on this company as time goes on. But Ridvanquin as well as Skyrizi are 2 drugs that they have in the pipeline. They really have a very strong pipeline, and they expect these drugs to sort of recoup that revenue as early as 2025, but more likely 2027 is the high probability scenario. The stock responded to the pipeline news, not so much on the earnings, because the earnings, again, they're lukewarm. And so we've seen this stock actually come out of it's come back in the last couple of days. But we really like this name. And the other thing to really notice here, and I'll highlight this with Disney too, is the multiple on this name is next 12 months is just under 13. And that's down from 22.5 trailing. So what you want to take away from here is it's a cheaper stock in relative to where it's been in the past. And I think in this environment, those are the type of names you want to own. I'll tie that in Disney. I'll tie that into third last company to Intel. Let's move on though on this. And Jannis, why don't you jump into some of the micro data here with AbbVie?
Yeah, I think it's spot on when you highlighted that the way that the stock currently behaves is definitely in response to what the market expects from the pipeline. They currently have about 13 oncology drugs in stage 3, and really the Skyrizi and Rinvoq drug are really ramping up in sales here. You have on the Rinvoq side, it's another arthritis drug, but it also treats IBD disease, which includes Crohn's disease, and Crohn's disease is one of the diseases that the drug is indicated for. And those trends keep pointing up and into the right. And then you also have the fact that the market is probably positively surprised in terms of what the Humira sales trends are looking like when you had the patent expiry globally. I mean, AbbVie fought in an epic battle in terms of retaining the Humira patent in the US. They lost it much sooner than that abroad. So when it expired in the EU back in 2018, you had consecutive sales drop by about 19% on an annual compounded basis. And then in the US, it's expected that until 2025, Humira sales will drop by about 70%. So this is all about replacing those sales. And also, what does the product pipeline look in the future? They had this big $60 billion acquisition of Allergan. You can see here on the chart that it was really more about the Botox, more about the aesthetics that they acquired with that $60 billion acquisition. They have managed to bring down the debt load that they took on back then, and the additional dilution from the stock set that came with it. And right now, management seems to be more open-minded, not only in terms of investing R&D into their own pipelines and advancing those drugs, but also lifting that $2 billion cap that they had on acquisitions on the back of the Allergan acquisition that they had. So they are more open-minded in terms of making new acquisitions, seeking out more targets. And this is really all about replacing that big blockbuster drug. I mean, Humira, I think, was the best-selling drug on the planet in terms of annual sales. So as they lose that, it's all about the confidence in the pipeline. How fast can they replace those sales? Bill, I'll kick it back to you. Why don't you run us through the chart here?
I mean, this chart is a beautiful chart. It's really as simple as it gets. You got a trend line going back to 2020 here. It tested this ahead of earnings. We responded from that. Say, let's call it 143. I mean, you want to own the stock, almost irresponsibly long in some ways. You want it is especially with trading and managing risk above 143, it's a long. I mean, you can't deny that trend is there. Furthermore, I mean, you got the previous high. I think that was like 2018 or so, and that was where we broke out above 2 years ago, and coming into 2022. Before that, bigger run, and so from there, I mean, that's your line in the sand. I mean, it's pretty simple. You want to be long or own AbbVie in portfolios until it breaks below that horizontal line. So it's pretty simple. Again, in the near term, 143, and then the other is the previous highs. If it ever surrenders those, you really got to reevaluate owning it in portfolios. All right, well, let's move on. The next one here is Disney. Obviously, a hot topic right now. Bob Iger back in the driver's seat. We picked this stock up in December. I was pretty vocal about it in December, adding it, selling Netflix after a big rebound in Netflix. Disney was at a lower end at the time. We put a little extra cash into Disney, and it's a name that's responded very well this year to Iger, even before the earnings report. It's actually traded higher after earnings, kind of come back in from there, and it's given us an opportunity to add that. It's one we would even like to be adding a little bit lower if it dips below 100 as well. First, I'll just start with the theme I mentioned in AbbVie. This is Disney's multiple right now, just above 24 next 12 months. It's down from 60. So another one where you're trailing 12 months. You're getting the next 12 months significantly less than the trailing 12 months. These are the type of stocks that we want to own in this environment. So that's something we're there. But again, let's focus on Bob Iger here coming back. And I may sound like a broken record on this. Disney is the greatest storytelling company of all time, and now they got their own story to tell. That story really started with Iger coming back, but it really took off, the story itself, with him as a people pleaser, and really giving everybody something that they wanted. That in that earnings report. Most importantly, you gave breaking away Disney, their linear network, their catalog, their streaming, breaking that out to its own division, and then you got the parks, the entertainment, the products, and ESPN put into a separate division. But the focus really is that Disney division where you're really going to run with the creativity now. That's what they've done best. Allow them to run with that. I think that's going to be something to really keep a close eye on. It's the streaming space is going to be a really big battle. But Disney has a deep catalog. They got the Hulu, and then we'll see what they end up doing with ESPN. What do they end up doing with Hulu? I mean, there's a lot of options here moving forward. So, I mean, we like the name. And one of the things I've been pointing out too is their subscribers. They did lose subscribers in India, so the subscriber numbers were not as bad as they seem. That's a one-time loss. Subscribers. It was at the network. It was tied to sports and media, but it was based in India. So they did lose those. But again, I think it's a one-time event there. Again, I like this name a lot. I think it's going to continue to be a story here as the year develops. Jannis, why don't you hop in here and tell us a little bit of micro on this name?
Yeah, those were a lot of really good points here, Bill. I think the main shift that's currently happening is really the shift from linear streaming, meaning a scheduled TV, to on-demand, direct-to-consumer streaming, and that's what they're doing with accumulating more than 100 million subscribers with Disney Plus. In the overall network, they have more than 200 million subscribers already, so that accounts for ESPN Plus, Hulu. It also accounts for the Hotstar network that they have in India, and it, of course, accounts for Disney Plus, where they're accumulating a lot of subscribers. But as that shift happens, it means they have to invest a lot more in content. They have to build out their own streaming platforms, and that takes up a lot of cash flow. And one of the luxuries that Disney has, though, is that their parks business is really strong in the midst of the shift. So whereas other brands that are solely focused on the streaming do not have this luxury, Disney has the ability to sort of subsidize their streaming shift with the parks operating income that they generate. If you just look at Q1 fiscal earnings of Disney in the park side and the merchandise side, those earnings, if you extrapolate those out for the remainder of this year, are going to be $12 billion in operating income, up from $7.9 billion last year. So you do see strong trends. You'll see strong sales trends in that segment, but you also see some of those same trends in the media, in the direct-to-consumer. You see that real drop-off in linear streaming. And I think what really comes down and what the crux of this stock is the fact that advertisers are really shifting their ad spend from the linear platform to digital advertising. And that's really why Disney is shifting its focus. I think that's really the main theme here with the stock. And can they capture those additional ad dollars? What is their pricing power gonna look like? They did point to a domestic price increase of Disney Plus only resulting in a small churn increase. They are more focused on accumulating quality subscribers rather than being in a race for the number of subscribers, and that's the race that they have been in against Netflix and against some of the other streaming platforms out there. But this is all about scale. Can they accumulate as many subscribers that they ultimately can support profitable growth with? So I did like, as you said, Bob Iger catered really to multiple camps of the investor base. He's more focused on profitability. He's also focused on succession planning. A lot of the criticism that Trine funds the active at Nelson Peltz in the stock had, a lot of these points got addressed. So I'm encouraged by where the stock's headed and potentially being this inflection story as they pivot from linear to direct to consumer.
Yeah, it's good stuff covering that. Finish off Disney here with the chart. I mean, overall, this thing just fell out of bed last year, created a little bit of a wedge, and it found support going back multiple years, many years, where this was sort of breaking out, retested a little bit through the pandemic. Great. I mean, it's a great looking chart as we sort of break out to that, but we expect volatility to continue, and we just see a lot of value at this area to even down from here a little bit over the longer run. So it's definitely something to keep an eye on. Take a look at the chart. We have a great chart book in general with all the slides for you. So dive into that. We encourage you to dive into it after when you're watching this thing. Let's move on though to Intel. So Intel is an interesting name. It hasn't done much over the years. It's just sort of this the dog in the race overall. It's lost lost its leadership as a chip brand to AMD and CPUs, to NVIDIA and GPUs, and then now they're trying to jump into this fabrication and really take hold in there by building out the fabrication plants, where Taiwan Semiconductor is really the leading horse there now. The problem is it's going to cost a lot of money to build these out. In a time where you had a lot of revenue that's been sort of kind of priced in with a lot of personal computers being purchased, and so a lot of revenue in the past that's there. The question is what's going to carry them going forward as they spend a lot of money. And so inversely, do we talk about next 12-month multiples significantly less in the trailing? Intel's a different story. Intel, you're looking at a next 12 multiple of 52 compared to the trailing of just a touch over 14. So you're looking at something that's good. It's really now it's a much more expensive stock, a lot of uncertainty going forward. We don't own this name, and we don't plan on owning this name at all, but it is not falling within that category of things that we want to own, given if we're looking at it from a multiple standpoint. So a lot of questions going forward here at how successful they are even going to be in building up these fabrication plants. Jannis, why don't you take us home here with the micro there?
Yeah, a lot of good points made again here. I mean, they've been this iconic chip brand, and they've lost market leadership in a lot of the areas. I think one key trend is that they're really dependent on a lot of desktop and notebook sales. And as we all know, that in 2020, 2021, and maybe even 2022, a lot of people purchased a lot of notebooks, a lot of desktops. So they do face a steep comparison here in the quarters to come. And then you have the fact that they have a lot of fixed costs with those fabrication plants that they are competing with Taiwan Semiconductors, but also with Samsung, both of which are ahead on the technology that these companies provide compared to Intel. So while most chip companies have taken an approach where they outsource the manufacturing, just because manufacturing those chips is so capital intensive. I mean, these are $20-40 billion chip plants. I think Intel has an agreement with Brookfield, where they're building a new plant for somewhere $40 billion or more in Arizona under the CHIPS Act that Congress passed, but these are a lot of capital intensive projects. This is a lot of fixed cost that goes into these projects. So as I said, a lot of semiconductor companies have taken the approach that they design the chips, they use software like Synopsys, which we have covered in the past, but then ultimately they give the chip design to Taiwan Semiconductors, to Samsung, to fabricate the chips. And Intel has taken an approach where they have both the fabrication and the design, and if they can't keep up on the fabrication and the technology that they offer, they are falling behind while continuing to incur that fixed cost. So ultimately, it will be an interesting question whether they make a shift and whether they also outsource, but there doesn't seem to be any sort of pivot as they continue to increased spending under the CHIPS Act. And then I think one interesting trend too is the fact that Intel is 27% of revenue does come from China. So maybe a lot of people have been hoping as China reopens, we'll see some tailwind there. But the question is also, if all the Chinese have been locked inside for so long, will that even increase the desktop and notebook sales in the quarters in the year to come? It is definitely an open question mark. This is more of an inflection story in the chip space, but it does have a lot of open pathways that the stock could be headed, but it remains quite uncertain as of now.
Yeah, I think it's great to cover that. One thing I'll say is you covered Synopsys and the automation side of it all. They just reported earnings. Before this earnings report, they were testing all-time highs again. I mean, not many tech stocks out there with that sort of multiple that have been testing all-time highs. However, they did water down guidance. It's a name that we own, a name that we have owned. We covered it again in a couple podcasts back. So go check it out. If you can look back at Synopsys, great one to look at. We'll wrap up here with this Intel chart, and I mean, there isn't much here. I mean, we had a nice rally when everything rallied, but it never got back out above the bubble high. And basically, I highlighted this apex. So you have this decade-long consolidation, this wedge, and then sort of the apex of that wedge aligned with the previous low, and that's the low we happen to retest. So that's your line in the sand. I mean, you do not want to see Intel take that out. Upside though, the previous bottom feeding before breaking down. I mean, we get up there. We got the previous back test of a trend line now in that range. I forget the dollar. I can't see the chart, but I forget that number. But if it goes there, I think that's going to be maybe all the juice you're going to squeeze out of that orange in the near term. But thanks for watching. Thanks for checking this podcast out. It's another fun podcast, and don't forget to check out our chart books. Some really great slides, great charts, some really great stuff in there to help you. And as always, give us feedback. We love to connect with you. But again, thank you for watching, and we'll check you next time. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.